Hey everyone, I'm Mark Sir, product manager at savingforcollege.com. And on behalf of the whole team here, I'd like to welcome you to today's Saving for College webinar. As we give everybody a moment to join us today, I'd like to have you join me in thanking our sponsor, the T. Rowe Price College Savings Plan, for their generous support of today's free webinar. For over 20 years, the T. Rowe Price College Savings Plan has been helping families save for college and other qualified education expenses in a tax-advantaged way. This 529 plan offers a variety of professionally managed investment options designed to address different time horizons and investment strategies. The plan also offers online tools and insights from T. Rowe Price certified financial planners so that families can develop their college saving strategies and be more confident about providing for their children's higher education needs. And speaking of those T. Rowe Price certified financial planners, I'm joined today by Mr. Roger Young. He's a thought leadership director with T. Rowe Price and does a lot of research on college financing topics. It's not his first time joining us for these webinars, so we're always thrilled to have his perspective, both as a professional, in this industry, and also as a father who's saved using a 529 plan quite effectively. So we really appreciate his perspective here today. So thank you, Roger.
Thanks, Mark. Happy to be here.
Yeah, let's jump right into things today because there's a lot to cover. We're going to try to cover as many of the most common questions about 529 plans as we can. And folks, if you do have questions, points of clarification that you want us to address, please just use that Zoom Q&A function. And we'll try to keep an eye on that so that we can address your questions as they come up. And we'll certainly have some time at the end to address some other questions you might have. So let's start at the beginning. And this is a question that's kind of core here to getting started with your plan. But it's also a really difficult question to answer because there are a lot of different variables that go into this. And every family is a little bit different when they're thinking about what they're saving for. So Roger, how much do I need to save for college? What is a realistic goal? I'm going to go ahead and drop a link here just of our college savings calculator for folks to kind of play around. This will be in the chat function, folks. But Roger, I know you've done some research on this and trying to come up with some sort of a rule of thumb for families. So what would you say to kind of help families get started here and how much they need to save?
Sure, it is absolutely something where people need to do their own work on it, but a rule of thumb or a starting point might be helpful. And yes, we've looked at a number of factors, including what's a potential trajectory for people, as well as what do people commonly do. So using some of the research out there on how people actually do fund college, and some numbers that we came up with, again, very broad rules of thumb, would include aiming to get to half of the published sticker price, plus room and board if that's appropriate for you, by the time around the time that your child is going to college, or maybe include some contributions once they're in college in that number to get to 50%. So why not 100%? Well, of course, there are other ways to fund college in addition to your own savings, and people take advantage of those, and it's reasonable to do that. So a few examples, scholarships could easily be 20-25%, for a lot of people. Not everyone, but a lot of people. Loans are reasonable to a point. So having some level of debt is not inappropriate. And of course, there are other potential sources like the student working during college or before college, getting help from family and friends. So a number of things can cobble it together, but aiming for that half number is a pretty good start. One of my colleagues, Judy Ward, will sometimes refer to it as a down payment on college. How do you get to that 50%? Well, our research also suggests that using hopefully some reasonable conservative assumptions, if you're talking about an in-state public college and including room and board, and someone who's a new parent, so saving from birth for a child, roughly $250 a month is a decent starting point. And that's something where you can start, there, lower if you have to, but try and get up to that number or adjust that number upward if your, aspirations for your child change. So, the $250 is not trivial, but it's also hopefully not something that you just say, oh, I have no way of ever getting there. So we're trying to be realistic as well as lay out the reality of college is an expensive undertaking, and you don't want to go into the college years having undersaved relative to your income.
No, really appreciate that, Roger. And you kind of touched a little bit on room and board and some of the other expenses. I think it's just really important to have some sort of a goal, right, of what you're saving, and that'll really help you, I think, mentally just stay committed to it. And so, let's say that maybe that $250 isn't reasonable for my family. But what are some of the other expenses that we might be able to defray so that we don't have to take on too much student debt here by using our 529 plan?
So when you say, sorry. So yeah, the other things that a 529 can pay for, sure. I think tuition, and mandatory fees are the big one. Room and board is an interesting one in that it is a qualified expense for 529 plans. It's not a qualified expense for some other tax advantages and tax breaks that you could get for college. So it is a nice feature of a 529 plan. You can see up on the screen things like mandatory books and computers and things like that for college can be included. More recently, K through 12 tuition is eligible for use with a 529. We tend to recommend that people use 529s more for college. Think longer term rather than K through 12. But if that's important to you, that it is an option. And of course, there are other things that you can't use a 529 for, at least in terms of the qualified expenses that come out tax free. So things like transportation and other living expenses other than the room and board. But all of that put together, it's still a fairly broad look at major components of the cost of attendance of a college.
Yeah, thanks for that, Roger. I did just share a link to this page here in the chat. I think this is a really useful table for folks to kind of review because it covers both, what is a qualified expense. And like you were saying, Roger, there are a few items to be aware of that are not qualified expenses that you may, think of as typical college expenses. So transportation to and from campus, like you said, and kind of parking passes or fees, unfortunately not going to be qualified expenses, and health insurance, even if provided by the school, is actually not a qualified expense. So just being aware of those, I think, is really important. On the room and board point, this is always a really common question that folks have about off-campus housing, right?
Yep.
If I'm not getting the bill directly from the school, if I'm, living off campus, can I still use my 529 funds for that? And the answer there is yes. And the key thing that you want to pay attention to is the published cost of attendance by your institution. So your institution is going to have a published cost of attendance that includes everything from the tuition and fees to what would be, off campus housing, what they consider the student budget. So just make sure that you're not trying to withdraw more than what is published there in your cost of attendance, because that is where it becomes a non-qualified expense. Very common question I wanted to check in on. And a great question here from Irene about room and board, again, the meal plan. Again, up to those published cost of attendance figures, whether you're on a campus meal plan or going to the grocery store, that is a qualified expense. Again, just need to make sure that you are not exceeding either what you are actually paying for those items or the published cost of attendance, whichever one there is lower.
Smaller of the two. Yeah, I can say from personal experience that the cost of attendance estimates are often not in keeping with reality in some parts of the country where there's been a lot of rent inflation, costs for food going up. So you do have to keep those numbers in check before you take the money out of the 529 if you want to stay within the qualified expenses.
Exactly. So hopefully that alleviates some concerns for folks who think their expenses might be a little bit limited. Now, we've talked mostly about college here. You'd mentioned the K through 12 expenses that are possible. Folks may have seen on the screen now, you're also able to withdraw up to $10,000 for student loan repayments, in fact.
Mhm.
So that's another option. So if my child, and this question can be phrased a lot of different ways, right? I call it the what if question. A lot of things can happen, right? My child might get a scholarship. They could be an elite athlete or simply, a great student and earns a full merit scholarship. Maybe, my student's going over to West Point, and they're not going to have any expenses, right, for that. And
Yep.
even if they don't go to college, what are kind of the options here? Maybe Roger, you can kind of break down some of these for us,
Yep.
starting with the scholarships.
Sure. So with a scholarship, you can withdraw from the 529 up to the amount of the scholarship, and you won't pay a penalty on that. So that's a nice benefit. Now, you would pay the income tax on associated gains for that, but it's still nice that, that doesn't make you in any worse shape than if you saved outside of a 529. There's no penalty with that. Um, if your child, similarly with the service academy, there's an amount you can take out there. Not going to college. So, this is, the thought of, well, over saving in a 529. And of course, not going to college at all would be the extreme example of that. If there's leftover money, there are a number of things you can do. Common one is changing the beneficiary to another family member. And there's a, reasonably wide list of what qualifies as a family member. It can include yourself. You can make yourself the beneficiary and use some money for college classes. Doesn't even have to be working towards a degree. You can kind of hold the funds indefinitely until someone in the family might be able to use them. Um, Starting next year, you'll be able to move potentially some money into a Roth IRA for the beneficiary. And we've got that coming up here on this slide. And I'll come back to this in a second because as you can see on the screen, there's a lot of caveats there. But the other thing to keep in mind is, it's your money if you've put it in a 529. And ultimately, worst comes to worst, you take the money out, you accept the penalty, you don't lose all of the money. And the 10% penalty hopefully is outweighed by the earnings over the years. I've even seen people analyze and say, it's worth it to do it even with the penalty. I wouldn't go that far that just blithely accept the penalty, but if you have to, you do. It's another reason to think about that first question of, well, not necessarily saving for 100% of the published sticker price. If you aim for that 50% or some other number, you have some flexibility. You're not likely to have oversaved. So that a number of things to keep in mind.
Yeah, and I think it's a really great point that it is still your money, right? Even if you have to pay a penalty, that's not going to be like 10% of your contributions, right? That's only going to be on the portion on the earnings
Yes.
of the growth of that account. So I think that's important for people to consider. You don't
Yes.
have to be working toward a degree. So maybe, you're going to Italy for vacation next year. Why don't you go take an Italian class at the local community college? You can, you're not going to be able to use it for room and board for that, right? If you're studying for less than half time, but you could certainly pay for those credits with your 529 funds. So there are a lot of different options. And as we kind of have teased, and I know there have already been some questions about this in the Q&A, really exciting kind of provision that's going to take effect here at the beginning of 2024. As part of the Secure 2.0 changes, we will be able to roll over 529 funds to a Roth IRA. And there are some limitations here. The total amount transferred is not going to be able to exceed $35,000. And essentially all other Roth IRA rules are going to apply. So that includes the contribution limit, which I think for this year might be like 6,500 for folks who are under 70 or so. And your income limit is still going to apply there. We've gotten some questions about, well, can't I just open a 529 plan if I'm not eligible for a Roth IRA and then just roll it over to a Roth IRA in a few years? And unfortunately, that's not going to be the case. It's really not meant as a loophole. It's really
Yeah.
meant to have this opportunity for folks who are worried that they're going to oversave. I think that's a difficult thing to do. I don't know how many folks have ever actually done that, oversaved in their 529 plan compared to what the expenses could be. It's certainly possible, and I understand the concern, and that's why we're really excited about this provision to just kind of alleviate that for folks. Anything
Yeah.
you want to add here, Roger?
Yeah, I mean, the plan having to be open for 15 years, that certainly cuts off the kind of backdoor concept a bit. And it has to be for the beneficiary. There are bound to be more rules coming out on this to make sure that people don't abuse it. But yes, the idea is you have a little bit left over, or even a decent amount left over. And typically when someone comes out of college, they're not necessarily earning so much that they can't qualify to contribute to a Roth IRA. They do need the earned income to do that. But yes, it's a way to kind of clean up some extra money if you have it. And again, the number of people who come back and say, "Wow, I wish I hadn't oversaved in the 529." Not a huge number in my experience.
All right. A few clarifications here on this topic. I know it's a little bit complicated. I know you folks have a lot of questions about it, so we're going to try to cover these really quickly here. So Philip asked about whether this is applying to existing 529 plans or new ones. And you see here, Roger had mentioned plan has to have been open for at least 15 years. So it does have to be a plan that's been in existence for 15 years. And actually, the amount being transferred will have to have been contributed to that plan at least 5 years prior. So it is really more for existing plans. Now that again puts kind of a sense of urgency for you if you are thinking about opening a plan. I would do so today just so you can make sure you can take advantage of those down the road. And there was also a question about the $35,000 limit, whether that's per year or lifetime. That's a lifetime maximum. There's actually a lower limitation per year. There's just your regular Roth IRA rules.
Yep.
And then one more about whether the money can be rolled over into the Roth IRA of the parent or the child. It's got to be the same beneficiary. So whoever is the named beneficiary of the Roth IRA has to also be the beneficiary of the 529 plan. So I hope that clarifies those questions for you folks.
One quick note, Mark, is that you hear people asking, well, what if you can change a beneficiary on a 529? What if I change that to myself or someone else? And I don't think we know all the answers to what the rules are going to look like, but I would expect that there might be some limiting rules on that type of thing. Again, with the idea of let's stick to the spirit of this, which is kind of cleaning up extra money and that it goes to the beneficiary as intended.
Right. Yeah, there's some more questions here kind of on these points. Whether we can elaborate on the amount being transferred contributed at least 5 years prior. Yeah, this is kind of one of those areas where we're waiting on IRS guidance. And so we're going to have to unfortunately refer to our asterisk down here that the IRS is going to be coming out with some further guidance on these provisions. So we'll keep an eye out on that. We will be publishing all these details on Saving for College as they do come up. Promise you that.
Great.
So now we've covered kind of the qualified expenses, some of the concerns about locking this money up. But Roger, maybe we can focus now on the benefits of the 529 plan, why we are, recommending folks open a 529 plan compared to, just saving in a savings account. And I think that the tax benefits are kind of core there. So I'm sure that you can, elaborate very effectively on the federal and state tax benefits of 529 plans.
Sure. For federal purposes, the key benefits are you get tax deferred growth. So you invest it and you get, you don't have to report the returns on that every year. From a federal standpoint, again, withdrawals for qualified expenses are tax exempt, tax free. So when you think about the combination of those two things, from a federal standpoint, it kind of feels similar to a Roth IRA, but it's for education, a different definition of a qualified withdrawal. And for state purposes, there could potentially be additional tax benefits. So, my state, Maryland, offers a tax deduction for a portion, a limited portion of contributions to a 529. So a lot of states have those. Some of them tie it to being their own plan. Some allow it for, any plan. Some don't have any benefits at all. And in some cases, you do have to be a little bit careful about taking the money out and the taxes on that for the state standpoint. So be aware of your own, state's rules if you have state income tax. So yeah, those are some nice benefits. And yes, you compare that to just in a kind of a regular taxable account or a savings account, the interest or dividends or capital gains that you have in those other types of accounts are taxed every year, as they're realized. So you get the benefit of delaying, and if it's used effectively, avoiding the tax on the gains.
Excellent. Yeah. And so hopefully folks understand how that can really accelerate, the amount of money that you have available when you actually come to withdraw. So, we have some questions here about choosing and opening a 529 plan. I'd love to workshop this a little bit. I'm going to share a link here to our comparison tool so folks can kind of go in and do some of the research themselves. But I like the framing here that Yennefer has provided for us. It kind of goes along with this first question here. And you say, I've seen that the 529 is for a specific state, and as a military family, maybe moving around a lot, how do we go about kind of making that sort of a decision? And so, Roger, maybe you can start by kind of addressing this first question about the state sponsorship and whether I'm kind of restricted in where I can go. And I'm going to share this link to our comparison tool so folks can go in there. We'll workshop some of the other considerations.
Great. So yeah, the short answer to those first two state-specific questions is essentially no. You don't really, you don't have to go with your own state's plan. You can generally use the money for, college in any other state. Now for this, we're talking about the 529 savings plans. Prepaid plans are a little bit different, and typically there's more of an advantage of staying in state if you do a prepaid plan. But prepaid plans also have some other limitations, and I think more people are participating in the savings plan. So that's largely what we'll be talking about today. Now, there also, as I mentioned earlier, there could be tax benefits of choosing your own state's plan. So that is definitely going to be one of your first considerations that you should have in mind, as you're choosing a plan. But there are other things like, who's doing the investing for you? What's the track record been? What are some of the other features and benefits? How user friendly is the website? Does it have a gifting portal? All sorts of things in terms of the service and the experience that you can consider when choosing a plan.
Excellent, Roger. So you mentioned the state tax deduction. So we're going to kind of show folks how to use this comparison tool effectively so that they can kind of compare the different features of plans. So you mentioned the state tax deduction or credit for contributions. Let's definitely compare that item. One that I'd like to include here is the minimum contribution. I just think it's helpful for folks to see, how little you really need to get started here. What is there something that sticks out to you, Roger, maybe around the investments or the fees, or other benefits that you think maybe we should kind of draw attention to for folks?
I see here you have one for age-based or enrollment year investment options. I do think that makes sense for a lot of people. We'll talk, I think, a little more about investments, but you are limited to doing a few changes in investments every year. That's not as onerous as it sounds. You can change what ongoing contributions are going into. When you take money out, you can generally choose what you're taking it out of. So, even as a financial guy, I've not felt terribly limited by the two investment changes per year. But, by doing an age-based, they're taking care of changing the risk profile over time for you as your time horizon shrinks, getting closer to college. So I think that's a valuable one to have and to consider. I think probably most would have that type of option. In terms of fees and expenses, you probably do want to at least be aware of whether a plan that you're looking at is what's called direct sold versus advisor sold. If you're going with an advisor sold plan, there typically are going to be some higher level of fees. So you have to ask yourself, is that, am I getting the value for that fee? Not to say it's right or wrong, but is it important to you to get advice on it? So those would be some of the big ones I would think. And your list is quite comprehensive here. So people can decide to look at other aspects as well that might be important to them.
Yeah, especially, Roger, you kind of mentioned there are certain states that maybe don't follow the federal definition of qualified 529 plan expenses. Some states don't allow you to make withdrawals for student loans or K through 12. So those are some of the things you can look at here, checking off state definition of qualified expenses. So this is a really robust tool that I encourage people to take a look at. I just want to clarify one item on the state association with the plan, right? Because we ask here, if we choose your state's plan, can you use the 529 funds in another state? And so if you're involved in any 529 savings program, right, not the prepaid programs, but any 529 savings program, you can use that at any institution in the country or around the world that accepts United States federal financial aid. So there are actually quite a few schools overseas which do accept U.S. federal financial aid. So that is not a concern. There are a couple of plans which do have residency restrictions, but you are never going to be forced to go to an in-state institution to use those funds, as long as you're in a savings plan. And frankly, a lot of the prepaid plans have come up with ways to allow you to use the money elsewhere also at this point. So
Yeah,
I just
it's typically not as good as using it in state, but yes, they'll credit you with some interest typically, but that gets a little complicated. So
yeah, that's a good point. So just to kind of give folks an idea here, you can see really low minimum contributions for most plans. Some have no minimum whatsoever. Others as low as $25 to start, $10 subsequently. You can get any kind of the information about the age-based options, who manages those, and of course, the details on your state tax benefit. You see Arizona here is what we call a tax parity state. And so they actually allow you to get that deduction regardless of the 529 plan that you open. So if you live in Arizona, a few other states, including Pennsylvania, Ohio, definitely take a look at the myriad of options that you have, because you don't necessarily need to open your state's plan to get that state tax benefit, which is really attractive.
great.
So I hope this kind of helps people get started in figuring out, which plans are the best for them. Talked a little bit about the minimum or maximum contribution limitations. Roger, do you want to elaborate maybe a little bit on the investment options, kind of, and really at a basic level, right? It's like, how do these funds get invested, right? How do they grow? I think there was a question asking like, why are the 529s not paying out like dividends on a regular basis, right? So maybe you could kind of clarify some of these aspects for folks and where these funds are being invested.
Sure. Yeah. So, I mean, I think if you're familiar with, a 401k plan, you might find the investment options somewhat similar. There's typically a limited menu. There's a company that manages it, like T. Rowe Price. And, so often there are the age-based. There are often other options like individual funds, kind of all equity options ranging to all very conservative, bank account type of options. In terms of things like dividends, it's a good question. A lot of times, the underlying funds that are being invested in might have dividends, but because this is intended to be a longer term, reasonably long term investment, and it's tax deferred, often those are reinvested. So, I wouldn't read too much into, it not paying a dividend that goes outside of the account. In fact, you probably, for tax purposes, prefer not to have that
Right.
money go outside of the account. So yeah, I think, again, there can be very low cost index type of funds available. Other ones that are actively managed. My firm tends to do more on the actively managed. We obviously think that there's value there. But if you have a particular opinion on that, you can probably find different plans that give you choices that are in line with your views. I also did want to point out with the restrictions, the minimums, as you mentioned, don't tend to be terribly high. The maximums, there are two types of maximums to think about. One is lifetime, the amount of contributions. And I actually just looked up on your site this morning that typically those range from about $235,000 to $550,000. For the typical person listening, that's probably not a binding constraint that you're going to go higher than that. But for wealthier people, it's intended not to allow kind of unlimited deferral for a long period of time. The other thing is, within a given year, for most people, you would want to stick within the annual gift exclusion. So for 2023, that's $17,000 per year, per person, per beneficiary. So, if you're married, you and your spouse could each give 17,000, put it into, one child's 529, and then another 17 and 17 to another. So again, not a terribly tight restriction for most people. For people who have, a lump sum that they can put in, there's also a what's called a 5-year. I think I forget the exact term, but you can combine 5 years worth of grants into 1 year. So $85,000 per person per beneficiary, with the understanding that then you don't get to do that every year. You do it once, and you don't do any more contributions for the next 5 years, and that you're able to do that without having to file a gift tax return or eat into your lifetime estate and gift tax exemption. So some nice features of the 529 plan in terms of a gifting and estate strategy, even for people who are thinking longer term to their estate plan.
And I think this is a big difference between 529 plans and some of the other tax advantage vehicles that you could use for education savings, whether that be a covered LESA, UGMA account, even the tax advantage bonds that you can use for education. There are income limitations which don't exist with 529 plans. There are much lower annual contribution limits. I think the covered Ls are about $2,000 a year. So there are these, restrictions on those other accounts that don't happen with 529 plans. And that's why we, are always such an advocate for 529 plans as the vehicle to use to save. Now, I think there was a really good question here in terms of, the choice of plan. What if we make the wrong decision or we move? Can we roll over the funds? And what restrictions are related there? And I know that this is an item that you can check off on that comparison tool, folks. Restrictions on rollover, so definitely check that out. But I guess the key point here, Roger, is that you can roll over funds to a different plan. I think it has to be completed within 30 days. So you've got to make the withdrawal and then deposit that into a different plan within 30 days. So that's something to be aware of. Anything you would want to add there for folks to help make them comfortable with that concept?
I mean, I think, check into the details for the plans that you're talking about. But yes, I've not heard people saying, "Oh, I'm stuck." So I'm not an expert in the logistics on that. I've been thankful I haven't had to do that myself. Although my kids are old enough that I started investing in 529s before I was in my current state, Maryland. And Maryland didn't, even when we got here, Maryland didn't have a plan at that point. So I used two different states' plans for my kids, and that was never an issue for me. But yes, if I had been dissatisfied with one of them and wanted to move it, I certainly could have.
Awesome. Quick question here from Albert. So his grandson is living in South Africa, but is a U.S. citizen, has a social security number, so wants to know if he's able to open an account for him. Absolutely. And he would, yes, be able to kind of access the account via the web to know what's going on there. So that's no problem whatsoever, Albert.
Good.
So I like this question because it can be an opinion. I have my opinion. I'm sure you
Mhm.
have yours, Roger. But it's a really common question. Folks who are saving for multiple children or multiple grandchildren, right? Nieces, nephews. Should they open multiple 529 plans? Or should they open one plan and then, like we've been discussing, kind of change the beneficiary as they go? What's your thought there?
You know, you could make an argument for keeping things simple with just one plan, but I honestly I think there are more good reasons to do multiple accounts. One is, the kids are, unless you're talking, twins and triplets and all that, they're probably different ages, so that's different time horizons, so different appropriate investments. If you're trying to keep some sense of fairness across your children, having multiple accounts helps you, try to be as fair as possible, at least in terms of contributions, if not the returns that they'll see. Um, I don't think it's terribly burdensome to have multiple accounts. Other people might have a different opinion, but you have more flexibility if you're doing multiple accounts. You could even make a change in one that you don't make in another. So I think multiple plans is generally the way to go, and unless you're really trying not to have unnecessary complexity, but you're probably dealing with the same plan and same sponsor company or financial institution for all of them. Might even be on one statement that you get. And as you kind of alluded to, eventually when it's time to take the money out and pay for a kid's education, well, it should be under have that kid as the beneficiary at that point. So you're going to have to split them probably at some point or another. So why not just do it from the get-go? That's my view. And actually one of our other panelists felt very, very strongly in favor of multiple plans. So
Yeah, my view is it would probably get more complicated if you have to be changing beneficiaries all the time, especially if they are close in age, right? How are you going to, handle twins in one account or going to college at the same time? I think that would be, more difficult, in fact. And folks, again, click on that enrollment fee option for the comparison tool, and you'll find that I don't think any direct sold plans charge like an enrollment or account maintenance fee at this point. It's all based on the assets there, so it's not like it's going to cost you anything further. So
good
important to
point.
realize.
Sure.
Okay, so talking about older children, right? Typically we talk about having 18 years to save and all this tax deferred growth. And there's kind of an associated question, I think, here about the investment options and about FDIC insured investment options. And so the question here is, are 529 investments considered FDIC insured investments? And the general answer there is no, though it does depend on your investment option. So I think something like 30 plans at this point offer an FDIC insured option, either through
Mhm.
savings accounts or CDs. And so if you are saving for an older child and you're concerned about, taking on market risk, please, folks, don't try to catch up at the age of 15, 16 by having an aggressive, equity mix or something like that. But, especially with interest rates quite high, the opportunity to just, especially, you're sitting in a savings account that's not tax deferred, at least just bring it into a savings account that is tax deferred. You're not going to have to pay, federal income tax on that. So Roger, when we're thinking about older children, anything that you would want to add there? I know it's always going to be more difficult, right? If you start late, but I
Sure.
don't think that you would say no, don't open a 529 if your child's 15.
Yeah, I think that your point about the changing interest rate environment is definitely valid because a few years ago it would have been hard to make the case that for a lot of people, the 529 plan had huge upside for an older child. If you're getting very little interest on conservative investments. Now, there's meaningful interest rates on a lot of the vehicles. And so there is some of that tax benefit. And of course, if it's outside of a 529, you're paying what's called, ordinary income tax rates, which is higher than, the rates that you'd pay on, say, long-term capital gain. So, yeah, you do get some potential tax savings there. And if you're in a state that has the tax deduction for a contribution, yeah, an older child, you can definitely benefit from that as well. So, yeah, not going to pretend that it's overwhelming, but it's not trivial. It's a benefit worth looking into.
Awesome. So I've seen a lot of questions about financial aid, and I want to kind of address that now and also discuss grandparents, because there have been some changes recently where this has become important. So the impact of financial aid, or the impact of a 529 savings on financial aid, is mute. It is considered a parental asset on the FAFSA. And so that's advantageous compared to other savings vehicles, especially, if you're saving in a savings account that your child is named in. That's going to be considered a student asset, and that's assessed much more highly for financial aid. And so while the question of does a 529 plan influence financial aid, the answer there is yes, but it's much more muted than other vehicles. And it doesn't have a significant impact on the actual dollars you're going to see. Because when you think about federal financial aid, you're typically talking about loans. So it's not as though you are losing out on like merit scholarships. That's simply not the case. You're not going to lose a merit scholarship based on your 529 funds. I joke, Coach Saban does not care about how much money you have in your 529 plan if he wants you to play quarterback at the University of Alabama. So that's not a concern that people need to have. And there was a concern up until this year about grandparents and a 529 plan that was owned by grandparents and how that impacted financial aid. Because when funds were withdrawn from a grandparent-owned 529 plan, those became considered student income for that year. And that is assessed at like 50%. So that, would directly pretty much drop down to your what was called the EFC and is now the Student Aid Index. So that was a major concern for grandparents who were saving in a plan that they owned. That is no longer the case with the recent FAFSA simplification. So now any outside financial assistance, whether it be from a grandparent, whether it be from an aunt or uncle, a non-family member, those are not considered student income anymore on the FAFSA. And that is going to really enable grandparents to save using 529 plans that they're the account owner for without worrying about having such a negative impact on their financial aid. And so I really hope that alleviates that concern, because I totally understand, why am I going to save all of this money and then I'm just going to lose it on the financial aid side? So I hope that these points here kind of alleviate that concern. Roger, if you have anything else, please feel free.
Oh, yeah. I mean, it definitely changes the game in terms of the attractiveness of a grandparent-owned plan. And as we mentioned earlier, thinking about kind of the unique aspects of 529s, you're giving what's considered a completed gift when you put money into a 529 plan for a beneficiary, but you still maintain control over it. So, in the past, grandparents might have been concerned about, I'm just kind of putting this in, 529 opened by my child, the parent of the student. And I don't love that I'm losing control. Well, now you can have both control and avoid any sort of financial aid impact for aid that's affected by the FAFSA. So yeah, that's a nice change in the law that's coming into effect now.
Yeah, so grandparents, now is definitely the time for you to open a 529 plan. You no longer have to be worried about, messing up the financial aid. So please, especially, because you folks are often the ones who have some time to do the research, very often, of more means. So your support is really important for the student's education. So we really appreciate those of you who are joining us today to try to learn more about it.
Absolutely.
So, I'm sure probably half, even more of the folks on this call actually already have a 529 plan. And so they may be a little bit bored up until this point, but I really want to spend probably the rest of the time here just kind of discussing the withdrawal concept. And Roger, I know you've gone through this fairly recently, and there's a good question here. What resources would you provide, or what advice would you provide to parents or account owners for how to facilitate a withdrawal? And it says here, schools and vendors seem to have different processes. So
Yeah.
maybe you could kind of give some advice based on your experience of how to approach that, critical time.
Yeah, for context, I have three kids, and my youngest is a senior in college, fourth year of college. So I'm 23 tuition payments out of 24 down. So yeah, I have a lot of experience in withdrawing. Typically, you'll need to look into the rules and the portals and the websites for your specific plan, but you'll often have a choice of with the money coming directly to you as the owner, or to the beneficiary, or straight to the school. I've always chosen to have it come to me so that I can kind of control, knowing that, I see the money coming in, and pay it out to the school and manage the taxes and all that. It does affect your taxes, in terms of forms you get and things you have to put into your tax return. I won't pretend that it's as easy as it should be. But for me, having it come directly to me was the easy way to go. You can choose one of the other options. I will say that the timing does matter, and I think Mark, you probably give more details on this. But the key is that it has, your withdrawal needs to be in the same year as when the money went out for tuition or room and board. And again, consistent with the cost of attendance limits if it's off campus. So you do want to be careful about the timing, and that can be tricky with money for, say, spring semester, that some colleges make it due in December, some colleges make it due in January. You just want to make sure that syncs up. You also want to make sure you understand exactly how they're filling out the tax form that they send you every year, because I've seen that can vary as well. So yeah, a number of logistics things here. I don't want to scare people into thinking, oh, it's not worth the effort. It's definitely worth the effort. But you do need to pay attention to the details.
Yeah, and I want to hammer home that point about the timing, because there was a specific question here from one of our attendees. Can I make a withdrawal against the plan, this spring, in anticipation that the child will be going to college next fall? You've got to make sure that the calendar years match up, and that's the calendar tax year, not the school year, right? And some people get tripped up with the withdrawals, like you said, for the spring semester, whether they're due in January or December. You really need to pay attention there, because you need to make that withdrawal in the same calendar year as you incur education expenses. So please, that's really the one thing that you can really mess up. And so I'd like to try to help you folks avoid doing that.
And for cash flow purposes, you do want to look at it a little bit ahead of due dates, because if you've got a plan that's invested, say, in mutual funds, it can take a few days for the money to go from the plan to your bank account, and from you to the school. So yes, if you don't kind of have that money sitting around outside the plan, you want to be thinking about it, say, a week ahead is kind of a nice rule of thumb to make sure you're not in a cash crunch.
Great question here from an anonymous attendee. Can I still fund the 529 while my child is attending college? And the answer there is absolutely. There's no reason not to. You can certainly start to save for like graduate school, or maybe you've got some funds left over afterward. and you can roll over to the Roth IRA starting next year, and maybe
Yeah,
you need to, use those 4 years also to fully fund uh,
sure.
the plan, which totally understand.
Yeah, absolutely. And yeah, it's kind of goes back to that question about, the benefits for an older child. Similarly, you're not necessarily going to have, outsized returns on a conservative investment that, you're, on a contribution that you're putting in while your child is in college. But yes, there's meaningful interest now. So yes, it's worth doing that, and kind of gives you the discipline of continuing it. A lot of people are kind of counting on, well, some of my income during the college years needs to go to help pay for it. So automatically putting that in a 529, helps you earmark it and keep the discipline.
Yeah, great question here from Matt. This is a tough one. There's no true answer here. When we're using like a 529 calculator, like the one I shared,
Mhm.
what rate of return should we use? Because you say here, the rate affects the result so much. And it does, and there is going to be variability and market risk. You
Mhm.
are investing in the market. Definitely take a look at what your investment option is investing in as far as the underlying funds. There are the opportunities, like we've mentioned, for FDIC insured or money market type investments that are a little bit more safe. So it does vary. I don't know, Roger, maybe you
Yeah.
could share like what you typically use
Yep.
when you're doing calculations.
Sure. I'll go into that a little bit. So if you read our, uh, content on, that savings article I mentioned earlier about how much to save, we start with kind of a baseline assumption of a 6% return over time. And, that's absolutely not guaranteed, as you know. And we also include, the other flip side of that is, well, what's the inflation rate going to be on college? And so we have what we think is, a fairly conservative assumption of 5% inflation on college. And I think, for many years it was up at that level. More recently, it's been lower. But yes, hope you do want to look at that gap between those two numbers, right? And so, 6% versus 5%. I don't think we're making heroic type assumptions on, what's going to happen in your 529 account. But that said, over a 5-year period, you could be well less than that. You could have a negative return. You could have much more positive number. I think you want to use a reasonable assumption and then revisit it fairly regularly, right? If things aren't going to plan, you could try to find, free up resources to contribute more. You could take a different investment approach. You could temper your, expectations on the kind of the type of education and experience that your child is going to have. So there are a lot of levers to pull. And with anything in life, there's a lot of uncertainty.
Excellent. Some further questions here. A point of clarification, when rolling over extra 529 funds to a Roth IRA and your Secure 2.0, you read that the funds had to be in the plan for 15 years. The plan does need to be open for 15 years. And then any amounts being transferred need to have been contributed at least 5 years prior. And there will be
Yeah,
further guidance from the IRS on what
yeah,
may constitute a resetting of that clock or what. But we're gonna have to
yeah.
wait for that, unfortunately.
Yeah, because I mean, obviously, the idea of the plans is, there's money going in, there's money coming out for college. So, money is fungible, as they say. It's hard to say this dollar,
Right.
ended up here or there. So yeah, I think some further guidance will be helpful there. Again, I think if you're trying to stick to the spirit of it, you're probably going to be okay. But yes, do pay attention to the rules as they come out in more detail.
Yeah, another similar question, but not specifically about the Roth provision, kind of the opposite actually. But rather than rolling over funds to a Roth IRA, can't I just hang on to them in perpetuity? And that's like one of the cool things about a 529 plan, right? Is you can use it for this multi-generational planning. The advisors get real excited when you use that kind of a term, right?
Mhm.
Multi-generational planning. So the audience member asked here, after my kid graduates, can I keep the unused funds in the 529, him being the beneficiary, and then later when he has a family of his own, change the beneficiary to my grandkids at that time?
I think, yeah,
Anything wrong with that, Roger?
kind of, short answer, yes, right. You can do that. Yeah, I'm not aware of any issues there, and certainly a reasonable technique. Again, here we're talking kind of first world problems, right? That the people who have a good amount to contribute and are in, good savers, typically higher income. So most people don't have that issue. But yes, if you have some leftover money, yes, you can kind of pay it forward to another future generation.
Excellent. Just reviewing some of the audience questions here, folks. We are almost out of time, so if you've got any further questions you want us to cover, please add those to the Q&A now. We have covered most of these questions. I just want to make sure we are able to cover everything that we can. Yeah, we've talked a lot about the FAFSA. Again, not a major concern, folks. It really isn't. You'll hear like the number 5.64% gets thrown out there. That's what parental assets are assessed at, when you're calculating the SAI. And so that's, much lower than basically anywhere else you can put that money, right? If you put it in the student savings account, even if you have it in your own savings account, I guess it would be the same. But again, not a major concern. I know that that's pretty much the dominant question in here.
Yeah, I mean, just to be clear, I mean, there could be situations where, if you're a relatively low income family and you're not going to be paying, say, capital gains taxes on an account, could a different type of account be better? Could it be better to not save and qualify for as much grant aid as possible? Yeah, maybe, but I don't think that that's a common situation where you're going to regret having saved anything in a 529. I mean, yes, maybe not over saving if you might qualify for Pell Grants or significant, college based, income based, need based aid. But again, I don't think that that's most of the people we're talking to here. And for, kind of the vast majority of people, the problem is usually the other side, where, you have relatively good income and therefore not a lot of eligibility and you haven't saved. So I would stress, don't be in a position where your savings are disproportionately low relative to your income. That's where it gets very hard to be able to afford college. So.
Excellent. And so a couple of last questions here that are, kind of back to basics, and then maybe we could have done a better job of explaining some of these nuances. Two sides of the question. First, like we mentioned a little bit about the differences between a savings plan and a prepaid plan. I'll talk about that one more time, but then also the difference between a direct versus an advisor sold plan. I think, Roger, when we were talking about the fees, you kind of mentioned that there may be some differences there. So I'll hit on the prepaid versus savings, and then maybe you can hit on the advisor versus direct.
Sure.
So with the prepaid plan, now I live in Florida, where I think we have the largest prepaid plan. You are buying units of future tuition at today's prices. And so you don't have to worry about the risk of the tuition and fees growing in the future, right? So you're buying the units now. So there are often like some restrictions as to how you can use those units, because it's a little bit different from the savings plan, which is kind of more of a traditional investing plan, where you put those funds in post-tax, and have them in the various investment options, stocks, bonds, age-based investment options, etc. And then that is able to grow on the tax deferred basis, right? And so then you'll have the pool of funds at the end, as opposed to having a pool of tuition credits, right, that you have prepaid for. That's the key difference there between a savings and a prepaid plan. And I hope that helps, folks. Most individuals at this point are choosing the savings plans, but there are, some states like I mentioned, Florida, that have really good prepaid plans, have robust public university systems where they're very popular.
Yes, and yeah, the prepaid is appropriate if you're really worried about inflation on the cost of college, for tuition particularly. And yeah, we're running out of time, but I will say, in terms of advisor sold versus direct. So for example, my company, T. Rowe Price, helps people with, in some cases with a direct plan. So, you go directly to, the state of Maryland as an example, um, and, work with them. And so you will pay fees on that, but it tends to be fees kind of like, a mutual fund expense. If you're going with an advisor sold plan, there's typically an additional sales charge of some sort or an additional asset-based fee. So again, the numbers all vary, but typically you're going to pay a little more for an advisor sold plan. If you work with a financial advisor, for example, it might just be easiest for you to continue working with that advisor to help you with the 529, and you might think that there's good value there. So be aware of the differences in costs and value proposition.
Excellent. It's a great place to end, Roger. Unfortunately, we are all out of time. So thank you, Roger. Thank you to the audience for joining us. I know that this is some complicated stuff, and it's really important that you've taken the time here to try to learn it. Make sure that your children, your grandchildren, your other loved ones that you're saving for are better off in the future. And of course, a very special thank you again to our generous sponsor, T. Rowe Price College Savings Plan, making this possible for all of you. Apologize if we weren't able to cover your questions today, folks, but you can always find more resources at savingforcollege.com. And I'm sure, we'll be hosting Roger again sometime soon. So definitely keep an eye out for that. So thank you all, and cheers.
Thanks, Mark.